Hello, welcome to this tutorial. Um, okay, sorry for the delay, but I was just waiting for maybe people to join, but since it's recorded, people can just watch this later. Okay, can you hear me well? Can you give me a thumbs up, maybe, a reaction? Thank you. Okay, so this is going to be kind of short. Okay, so today is tutorial is about risk analysis, especially for regarding portfolio management or like stock investment in general. In general, but we start by just an introduction about what is risk analysis. So when it comes to like risk in different financial um, um, investments, like all companies or corporations, non-profit, anything, any kind of project can include risk analysis. Risk analysis is a process of assessing the likelihood of a negative event and how it impact your process. So this includes like identifying the risk or the possible negative effect if event that can happen, and the uncertainty attached to it. So like any uncertainty, because like it's probable, you're thinking about a probable event that can happen and can negatively affect your process. And um, uh, and then is what you need to do is to basically calculate in a way or assess or estimate the effect or the impact on the process resulting from this event. And then you have to take decisions based on this analysis, um, based on the results you can see from your assessment. Take decisions like to either mitigate the risk, reduce it, or you can even like sometimes you can just say like the risk is not big enough, I can just like ignore it or tolerate it basically. So you have to basically in this risk management there is a estimation of tolerance level for risk. So depending on that you can decide like what to do exactly. Okay, so exactly what are the methods for this analysis? So there are like in details there are multiple methods to do this, depending of course on the what is exactly the sector or the process you are in, like what is your corporation doing, or is it maybe it's a company, maybe it's a governmental um, organization or something. Depending on where sector you are, like the risk or what kind of risk you are considering, it will differ the risk analysis method. But generally, there are two methods, or you can divide them into kinds of methods. One is quantitative risk analysis, and the other is qualitative. So in quantitative one, you are assigning, like you are using mathematical models and simulation to assign a numerical value to your risk. You are attaching actual numbers. In qualitative analysis, you are just doing like some kind of a judgment, a subjective judgment. You're using subjective judgment to like this involves like just like a written or just like a written quantitative. So there's no numbers involved here. It's just like an assessment of what is like a possible possible event that can happen, and evaluation of just like generically or the like the quantitative impact of this event, and like just a countermeasures plan. So this can be detailed plans, but it's like it doesn't include numerical estimations. While in quantitative risk analysis, this include numerical estimations and like use of mathematical statistical models, and also possibly simulations to assign a particular number to the risk. So we are here in our case, we are more focused on quantitative risk analysis, and in particular when it comes to portfolio management. So we're talking about investment in stocks and bonds, and we have a portfolio, or like we can consider like just a stock, one stock, and then here this like define this is just an investment. You have the number, you have historical data of the stocks, or like also the stock market in general, and then you can think of all the risk can be as attached to such investment. And there are different kinds of risk when it comes to like just to think about examples. So examples of risk that it comes with portfolio investment, you can have like the volatility of the stocks, or stock market itself, or the particular stock you're considering or investing in. So this volatility is the difference, ups and downs of the stock price. But there are other kind of risk comes with like the whole like events of like a decline in the whole stock market, or like inflation. All of these are different kinds of risk to think about. So okay, so here just like generically listed, this is the benefits or why we do the risk analysis generally. So of course, this analysis can be useful for us to prepare basically for negative events, and if we implement mitigation, mitigation like mitigation actions, we can minimize our future losses, and or like in other cases like this, I was thinking about investment, but like we can also, of course, this can be something that can cause like other kind of adverse effect, and we just want to have a plan to face those. So this risk analysis help with having a plan, reducing losses, reducing any kind of negative effects, and of course, especially for investment, but for other kind of processes, you can actually attach in quantitative analysis, you can attach a numerical value, and this is like make it easier to like to prepare, but also to compare different kind of like in, for example, in cost benefit analysis, you can assigning the numerical value helps with like doing that. So this is for the pros. For the cons, of course, is that sometimes like some of this risk analysis relies on estimates, and or like analysis of historical data does not necessarily give us it's not certain. Of course, it cannot really predict the future, and it of course it while it helps generally for events that like maybe have seen before, or in our lives, or like in the data that we have, or in historical data, but there are cases of unpredictable events that these you cannot really take into account, so you are not really completely like protected from those, like it depending on like how it is done, and sometimes like some specific methods of risk analysis or specific measures of risk can like don't take into account like doesn't show us like, for example, the if you think about the VAR, the value at risk, you'll see maybe the definition a bit later, what maybe you have seen it already. The VAR value, for example, sometimes can lead us to underestimate, or while it gives us like it's limited to a period of time, it can be like I would say it can be like it doesn't show us like maybe the most negative, or for a shorter period of time. It's like so it just have to be considerate when you're like careful when you're thinking about this. Anyway, so this is just an introduction, or like a generic thing. So focusing on investment, or focusing on quantitative risk analysis, and investment in general, in particular stock investments, we have to think about how to measure risk. So numerical measures of risk range from basic statistical measures like the standard deviation to more complicated mathematical methods. So I'm going to like just mention a few here, but there are more. There are more like indicators or measures for statistical for risk. So one, as I mentioned before, standard deviation is a measure of volatility. So when you consider the, so think about what is the standard deviation is. The standard deviation is, sorry. Is there the question, or is this a mistake? Okay. So think, as I was saying, think about the standard deviation. The standard deviation is a measure of the dispersion, or how different are the individual data points from the mean, right? So thinking about the average, say you have a stock price, and you are looking at the deviation of the stock price from the average price. So over a period of time, there is an average price, and then you like calculate the standard deviation of the prices here. And the bigger the standard deviation means that there is a bigger, like the price goes up or down far from the mean, the higher. So that means that is volatile. The higher the standard deviation, the higher the volatility. And of course, like this makes like the more volatile the stock price is, the more that means this stock is riskier. There is a variation of standard deviation which focuses only on what is called the downside risk, which is only considers the losses. The thing, like the standard deviation doesn't care, like when you calculate, it doesn't care about if the price is higher than the average or lower than the average. Higher than the average, that means it provides more profit, right? More return than was expected, or than the average. Or like if it's less, that means that there are losses, right? So the volatility here doesn't mean a loss. It just means like it's like the unpredictability or the volatility of the. It's just it's not focused on the loss. It's not about losses. It's about how different it is, how varied it is. But if you want to only focus on the loss, you can just consider the price points that are lower than the mean and calculate what is called the semi-deviation. And there what is calculating is a measure of volatility, but only focus on losses, not on not taking into account everything. That just depends on what you want. Of course, what you want to consider for your analysis, what you consider for your goal, what you use for measurement will depend on that. Okay. The next thing, the next measure of risk is a Sharpe ratio, our Sharpe index. So this is a measure of the performance of investment by adjusting it for its risk. So it's like the formula is here. So it's expected return minus the risk-free rate of return, and divided by the standard deviation of return, so of the volatility. So it is using the previous measure here. And so this one is like this ratio is like the high, it's like it's measuring the basically the ratio of investment uh, compared to the risk, compared to the risk it's included, it has. And so that means like the higher this ratio is, that means the return is high compared to the risk. That means it's like a better investment. So like there are like this um like guides of source that if the ratio is less than one, that means the investment is not good, is bad. From one to less than two, it is good, or like it's greater than three, it's excellent. So there are these like generic considerations, or like what is the standard, like um but like it can vary by sectors, what is the standard or the accepted values for this, but this is just generic thing. Okay. A third measure of risk we consider here is value at risk. So as like I kind of mentioned it before, but like it's okay, so consider like an asset, okay, and the value at risk basically it's a measure of what is a potential loss for a given period of time. So it's a given period of time with and a given confidence interval. So there are like depends on two values: a period of time and confidence interval. So just to think about it, I'm here like I'm listing an example. Think about if you have an stock, the Nasdaq 100 ETF, and think like if you could say for 1 year, is that it has the like you have the historical data for it for 1 year, and we see like what is like calculate the return, the daily return for that stock for this 1 year, and see, look at the worst 5%. Okay, for the loss, for if the loss sorry, the worst 5%, see what is the losses there, or like what is like the worst return. It doesn't need to be losses, maybe it was always like it was never losing, but say that the losses were like around 4%. We'll say that we have like that with 95% certainty, because this we're considered the 5% worst returns. That means with 95% certainty that this Nasdaq 100 is not going to lose more than 4%. So basically, if you invest $100, you are not going to lose more than $4 with 95% certainty. If you want to change the certainty or confidence interval, like let's say if you want to get a 99% confidence or like certainty, you will look at the 1% worst returns. Say for that period of time, you have the worst was 7%. I will say that like with a 99% certainty, you're not going to lose more than 7% in that period of time. So you see that the VAR value, before it was 4% because we were considering a 95% certainty. When we changed the certainty level to 99, it changed because we looked at the worst 1% of the returns, and that will give us like 7%. So you see like when you consider different certainty levels and different period of time, also will change this. If you consider like 1 year or it is like a shorter time, it will be different. So you have to take that into account as well. So these are like a few methods of, there are like a variation also of this value at risk. Uh, 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 like similar to the semi deviation from before, that's only focused on the losses. There is also a variation of the VAR, which is called so conditional value at risk, and it will sorry, it's not focused only on the losses, but it's a variation or it's a different value that will just consider like um like a conditional on a particular expected loss value, and just um it will calculate just the expected loss uh in for a particular level. Anyway, so there are like other measures of risk you can check if you want to consider more for you. And there are like each one of them has like a pro, like limitations. um so as I said before, for example, for the VAR, you cannot like you see, like it doesn't show you losses beyond the threshold. So like here, like I said here, like it was for 95% certainty, it showed you there is a four. See, I have $100, it showed me a $4 loss. But when I changed the threshold, it came to 7. So this is like one limitation of the bar. Also, like it might underestimate the when the periods of like stress, or like where the asset is at a bad period in particular. So you're averaging over a long time, you can miss times that are particularly bad. Also, like because there are different calculation methods, you can get different values. So okay. Any questions? Do you have any question? Is it clear so far? Or like, is this clear? Like, because this is the end, basically. I know it's like this tutorial is not, it's more theoretical or about the understanding of this, but you have any questions? If everything is clear, maybe give me a thumbs up so we can understand that. Like everything is clear for you. Okay, great. So I think we can, since everything is clear, we can end the session here. I would say, well, okay, do I have anything to tell you more about this? So for yeah. Yeah, so you have like in the suggested for you to use the VAR and basically standard deviation and sharp ratio. These are the ones that are suggested for you in the challenge document for you to use. You can, if you want, you can like as I said, look at more measures of risk. Like there is, for example, there's one that's called the beta ratio, and others. You can look them up. And yeah. Okay, so another variations of the Sharp ratio as well. Okay, so okay, as I yeah, so that I don't have more to tell you about this, but so I will end the session here. Yeah, I'm rambling. Thank you everyone for joining, and yeah, have a good day. Bye.